I think that's all for the housekeeping, so we'll go ahead and get started. As most of you know, my name is Hannah. I'm on the sales team here in Bend. I'm joined by Amy Telemarter. She's also here in Bend with me. Today is a special webinar as it is a worldwide Western class. So we have attendees from all over the state because we've collaborated with our sales team, Amy Corey, over in Eugene to put this on. So thank you all for being here today. We're very excited for today's topic. It's very relevant to us in our industry, and we're just thrilled to have Josh here. So Josh, thank you for taking the time to put this together and be here. So Josh is an economist. In short, he develops the state quarterly economic forecast, including outlooks for employment, income, and housing. No one better to give your bio than you, Josh, so I will let you take it from here.
Great. Thanks, Hannah and Amy. It's great to be here with you all. I can't see you on the screen, but I'm looking forward to the questions you have at the end. And I am an economist for the state of Oregon. You know what they always say about economists, right? Like, we're just like accountants, but without the personality. So that's what we're in for today. Hopefully be all right. And so our office, we do the economic and revenue forecasting for the state. As Hannah was saying, like, I do the economic forecasting, and then some of the fun revenue items, the vice revenues, the lottery, the tobacco, the marijuana, the psilocybin now, all that sort of fun stuff. So happy to chat about any of that sort of stuff. With that, let's dig in. We're in a little bit of a transition period right now in our office because our most recent forecast came out in August, and our next forecast comes out on Wednesday. So we'll be in Salem, really talking with the legislature and policymakers next week with our latest update. So this is a little bit of a hybrid between our old outlook and our new outlook. And overall, it's encouraging news across the board. And certainly the movements in financial markets in the last, even the last week, should put some sustained momentum, or at least certainly we've had a floor on the housing market, and that floor should be a little higher now with the improvement in rates, at least in the near term for sure, and probably in the long term based upon the outlook. And so I'm going to focus a little bit more right now because we've seen this shift in the market. We've seen this shift in the economy, in the economic data. You know, you're the first one hearing some of this commentary. And so first off, the Federal Reserve has a dual mandate, right? The maximum employment and price stability. They try and balance both of those things, and so they've raised interest rates quite a bit in the last 18 months in order to try and balance the economy. And for the last 18 months, for sure, the focus has been entirely on the price stability inflation part of the dual mandate, right? Last summer, inflation was running at a 9% pace. It slowed tremendously in the last year. We're now inflation in the 3 to 4% range, depending upon which measure you're looking at, which indices and which components and that sort of stuff. And you can get it even slower than that, depending upon how exactly you want to parse the data. And so we've seen a tremendous slowdown in inflation. It's possible it's going to slow down even more than anticipated. This is our forecast, where it's kind of like we don't fully get back to the Federal Reserve's they have a 2% target on one specific measure of inflation. By this chart you see here, it's kind of equivalent to about 2.5% in this headline CPI overall. And so, like, we don't have in our forecast until getting fully back to the Federal Reserve's target on a sustained basis until 2025. It's a multi-year process, right? Because some of this is going to take a little while to get that last couple percentage points out of the system. It's probably going to be a little bit harder than certainly these first handful of percentage points slow down in inflation. And so that's the baseline forecast. I still think that's probably the most likely outlook, but the latest data the last couple months have been really encouraging that the slowdown in inflation might be here sooner than anticipated. And so what does that mean? What does that mean for the outlook? Well, it means a couple of things. One is that the slowdown in inflation, while we continue to have good income growth, means our standard of living is rising again. Inflation adjusted income is rising again. For a while, it wasn't. For a while, we are getting some income growth, but it was slower than inflation. So like our paychecks were not stretching as far as they were. The slowdown in inflation while maintaining good income growth means our standard of living and our income growth is rising again faster. That should support consumer spending. Household finances are still in good shape. They have deteriorated from sort of the height of the pandemic when we had all the federal aid and that sort of stuff, right? Like our household balance sheets have, for a lot of people, have deteriorated from that high point, but they're still in better shape today than certainly back in 2019. And then from the Federal Reserve's perspective, the other encouraging thing is not just the slowdown in inflation. That's a little bit, the slowdown's a little bit more than anticipated. We've seen a rebalancing in the labor market, right? If we go back a year, certainly even if we just go back 6 months, the labor market was tremendously overheated, right? Like it just the number of job openings relative to the workers and trying to get everything fully reopened following the shutdowns and all that sort of stuff. It took a long time. And we are seeing like these really high wage increases and these really, really tight labor markets and increased competition to find workers and that sort of stuff. So like the labor market was overheated above and beyond what you could just call a normal, fully healthy, full employment style labor market. We were beyond that, right, for a while. And now the labor market has certainly come off the boil. It's rebalancing. It's in better shape today. It's still a strong, tight, healthy labor market, but is no longer overheated. And so the chart on the left, we're looking at Oregon data on all of this stuff right here. The chart on the left shows the job opening rate. So the number of job openings Oregon businesses are looking to fill as a share of the entire labor force or the entire workforce and things like that. You can see it's come down tremendously in the last 12 to 18 months, and we're roughly in line with what the job opening rate was in 2019, which again was a full, strong, healthy economy. And then the workers quit rate, the teal line at the bottom, is what percentage of workers are quitting one job, and then like 85% of people who quit a job are quitting a job to take another job. It's not that most people are quitting a job to go sit on the couch and play video games. They're quitting one job for a different job, generally one that pays higher wages and things like that. And so that churn in the labor market of workers quitting one job for another one has calmed back down, and we're actually running at rates back in 2017 here in Oregon. So again, the churn, the dynamics, all the crazy stuff that happened with the pandemic, the shutdowns and the reopening and the overheated labor market has certainly kind of come back down to earth, which is good news. And then the chart on the right is showing continued claims for unemployment insurance and benefit in Oregon, right? So we're comparing 2023 in dark blue to 2018, 2019, and 2022 in the yellows and the grays, right? Like, and so it's pointing towards a looser labor market, better balance in the labor market than what we've seen in the recent past. So again, like inflation has slowed, the labor market is no longer overheated, and so like the dual mandates are really going to come into play. And so how's the Federal Reserve starting to shift their thinking on this, right? This is a forecast of the Fed's fund rate, again, the short-term interest rate that they can control directly. They've raised it more than 5 percentage points since the spring of 2018. We've gone from 0% interest rates to over 5% Fed fund rate, which means we went from 3% mortgages to 8% mortgages effectively, right, over this time period. The Federal Reserve is still, in their most recent forecast, you can see here, they're saying they're going to raise interest rates one more time. And it was either going to be at the November meeting, which I think is next week, or the December meeting. The November meeting's already happened. The December one is like December 13th. And so I don't know if they're going to follow through on that, right? Given that slowdown in inflation and the better balance in the labor market, taking into consideration their dual mandates, like I'm not sure they're going to follow through on that last rate hike. And so then the question becomes, when are they going to start cutting interest rates? And the nature here is not for a massive reduction in interest rates. A massive reduction in interest rates is the hard landing, the recession scenario where the economy deteriorates significantly. And so they got to cut interest rates to try and generate some activity. It's going to be called what economists are referring to it as surgical cut. A surgical cut is they can start to, like, they slammed on the brakes, they can start to ease off the brakes and begin to allow the economy to coast because inflation is back down, right? Like we don't need 5% Fed fund rate and 8% mortgages. in a normal, healthy economy, we needed it when inflation was running at near double-digit rates, right? That's the reason for this massive shift in policy. Now that inflation has slowed, they can ease off the brakes and start to reduce interest rates while still maintaining relatively tight monetary policy, relatively higher interest rates than you would think in a healthy economy, because they want to ensure inflation gets back down to 2%. On a sustainable basis, not on a 1 month basis, but on a sustainable basis. And so what the forecast has been is raise interest rates really high, hold them there for an extended period of time, and then once inflation is sustainably slowing, ease off those brakes. And so the forecast was for 2 rate cuts in the second half of next year, in the second half of 2024. Whether that's going to come in July or September or November, don't know entirely. It'd be data dependent. So what this latest data has shifted, I think, the thinking on where the state of the economy is again not probably going to follow through with that last rate hike next month. And then if that's the case, that means the last rate hike was in July. And so now we're talking March or May as the potential, maybe even January, depending on how the data flows, but probably March or May for the rate cut. So that'd be going from July through March or May. So 12 months, almost 12-month period of holding interest rates relatively high. And then they're going to start easing off the brakes. And again, this is going to be data dependent. It's going to be about that inflation data. And we've had a small uptick in the unemployment rate nationally, right? It's up a couple tenths of a percent in recent months. So again, like that's putting that dual mandate of the maximum employment into play, where you got to balance those risks of, yeah, slower inflation, not slow enough, but it's slower. But if the labor market is softer than they want to see, then we could start to see those rate cuts happen a little bit sooner to try and just maintain the momentum and the strength in the economy. So again, this is going to be all good news for the housing market, because the interest rates are by far the biggest challenge today. And here we're just looking at the 30-year mortgage rate. This is the weekly survey from Freddie Mac. It tends to run a little bit slower than some of those daily real-time indicators that are out there. And it's like for people with perfect credit scores and all that sort of stuff, right? So it tends to be a little bit lower. And it's also lagged by a week. And so in the last week, these rates have come back down from running at 8% a couple of weeks ago. They're down in the 7.5%, 7.4% I was seeing this morning for the latest daily news. So again, that's going to be good news. Now, the challenge here is the yellow line, right? The difference between mortgage rates and treasuries, U.S. treasuries, in this case, the 10-year treasury and financial markets, the gap between them, right? A 30-year mortgage is a riskier investment than a 10-year federal treasury. And so there is a spread, right? The longer term and certainly above the U.S. treasury debt, like the private sector activity is priced at a higher rate because of the increased risk relative to the federal debt, which is like the global safe haven in financial markets around the world. But that difference, as shown in the yellow line, it used to be 1.5 or 2 percentage points. It's now running at 3 percentage points and has been running at 3 percentage points gap for a extended period of time, which puts extra upward pressure on mortgage rates in particular. And so the question is, like, can we get this to normalize? Can we get this gap, this difference between 10-year treasuries and 30-year mortgages to go back closer to the long run averages? And the answer is probably yes, a little bit, but probably not all the way back to where it was, because the Federal Reserve is no longer buying mortgage-backed securities. And in fact, they're selling them, or at least letting them roll off the books as they come to maturity and things like that. And there's been a lot of other issues in the financial markets. So like, we're probably not going to go all the way back down. But the point here is, if the Federal Reserve is cutting interest rates next year, which is the baseline expectation, and we get some sort of normalization on these credit spreads in financial markets, we could be talking about interest rates that are certainly sub 7%, maybe closer to 6% come 2025. And that matters tremendously. I'll talk about here in a bit, because a 6% mortgage rate with income growth would bring affordability back to average in Oregon. So that would be really, really good news. We're not there yet. We still got a long way to go. The housing market is still suppressed and operating at this really low equilibrium. But I think the things would start to move in the right direction to increase volumes of transactions and price people back into the market and all that sort of stuff. Again, I think the signs are there that trajectory is certainly improving. So when it comes to the economy overall, I'll just hit you with a couple things. This recovery from the pandemic has been faster, more complete, and more inclusive than any in memory. Here we're looking at employment rates on the left, right? This is the actual percentage of people 25 to 54 years old in Oregon that actually has a job. Not whether you're unemployed or searching for work or staying home to look for the kids, but what percentage of people actually have a job. You can see we're at a multi-decade high, both for white non-Hispanic Oregonians and Oregonians of color. And if we look at it a little bit more detail, we're at an all-time high for employment rates among Asian Oregonians and American Indian and Alaska Native Oregonians. When it comes to Black Oregonians and Hispanic or Latino Oregonians, employment rates are just a hair below their all-time high. So we're almost there across the board when it comes to actual employment rates, the share of people with a job in the state. And so that's really been an encouraging thing to see. And so some of these gaps, these historical disparities, they still exist, but they're a little bit smaller today than they were back in the pre-pandemic world. We all also seen smaller disparities when it comes to things like differences by educational attainment and differences across different regions of the state, right? If we think about last decade in the 2010s, it was the nation's large metropolitan areas that led growth coming out of the housing crisis and the global financial crisis, right? And so it was places like Portland. Portland not only led the state recovery, it also led the nation. It was top 10 in the nation last decade for things like high wage job growth, median household income gains, and stuff like that. Portland was a national leader and led the state. Obviously not the case this cycle. This cycle, it is the smaller and medium-sized metropolitan areas and our rural communities that have outperformed. Portland is still relatively healthy at, not just relative, Portland is a healthy regional economy at like the metro level. The urban core discussion is an entirely different thing, but we are lagging there. But at the regional level, jobs and income in Portland look just like jobs and income trends in large metros around the nation. But even so, our smaller metropolitan areas and our rural communities have outperformed this cycle, increased importance in those economies throughout the state, certainly relative to recent decades, for sure. When it comes to the future growth of the economy, this is a really textbook thing, a very economisty sort of thing to say, but it's going to be true, is there's two sources of growth for your economy. There's labor and there's capital, right? It's about how many workers do you have in your economy, and then how productive are each of those workers, and the combination there is economic growth. And so this scatter plot here is looking at productivity gains per worker on the vertical axis up and down, and then job growth, just how many workers are there, percentage from pre-pandemic through at least the start of the year, on the horizontal axis, left and right. And so where is Oregon? Like, we're in the middle of it horizontally, but at the top vertically. We're in the middle of the pack, but at the top on the productivity. So what does this mean, right? This means Oregon, we have seen good economic growth this cycle. Like, we've had good economic growth and good income growth in recent years, but the drivers of that growth has to do with the productivity. We're number 3 in the nation for productivity growth so far this cycle. You'll see Washington's number 1, Iowa's number 2. I don't know what's going on there. Oregon's number 3. So regionally, we've had really good productivity gains, which have been more than enough to make up for our middle of the pack job growth and population growth. And that's a little bit different, right? We tend to think of a place like Oregon as being, top 10 in the nation for things like job growth and population gains. Clearly hasn't been this case this cycle. We're more middle of the pack. We're a little below average, but middle of the pack. Not a huge outlier to the negative, but a little below average. And so again, our economy has been doing quite well, and we're going to need to continue to rely on that business investment and capital increases and productivity gains and things like that moving forward if we want to maintain good overall economic growth, because the labor front is not looking so great, both with the demographics, with increased retirement and smaller cohorts entering into the workforce, given our low birth rate and the slowdown in migration we've seen. All of that sort of points to slow gains in the workforce and the labor force in the years to come. So to maintain healthy economic growth, it's going to have to come much more from the productivity and business investment side. As we've been seeing, we just need that to continue. I think there's some encouraging reasons for why that will be increasing in the years ahead. It's going to have to do with our construction needs, right? We have a lot of federal money coming in the pipeline in terms of infrastructure, in terms of rural broadband, in terms of the CHIPS and Science Act with semiconductor investment. We have local, state, and transportation projects. We have to boost our housing supply, our housing production in the state. We have all these workforce or construction needs that will then, both grow the economy in the short term and make us more attractive and more productive in the medium term, which will then help grow the economy. here, just a quick note on the CHIPS Act, the semiconductor investment. Up until really, I don't know, 4 to 8 weeks ago, there had been really no information, no public information, I should say, on the upcoming semiconductor investments in the state of Oregon. We've seen these really big announcements elsewhere around the country, whether it's Arizona or Texas or New York or Ohio, of course. These other places were starting to get these announcements of new semiconductor investments, and we hadn't gotten anything. During that time, we hadn't gotten any major announcements, but we had gained 2 or 3 or 4,000 semiconductor jobs locally as our local semiconductor plants, fabs, were increasing production given the chip shortages during the pandemic and all that sort of stuff. Well, now we're getting announcements. Now we're seeing big expansion plans, obviously from our largest employer, in Washington County and in Intel. That's going to be the epicenter of a lot of this investment, but it's really, if we look at the applications for new state incentives when it comes to semiconductors, it's up and down the I-5 corridor entirely, with a couple over across the mountains in Central Oregon. We'll see how this plays out. These are just applications of like, hey, here's what I'm going to do. So we have built in some increased investments in our forecast and increases in semiconductor employment in our forecast, a tune of about 3,000 jobs and tens of billions of dollars of investments. That'll help drive productivity growth in our state. Of course, that's very, very Portland centric in terms of the footprint of the semiconductor industry. But again, these investments will be up and down I-5 and maybe 1 or 2 across the mountains in Central Oregon. So again, I've been talking about all these good construction needs. How are we going to build all of these things? That's the really hard thing to know, because we have a tight labor market. Everybody has a job again, and the demographics are not good moving forward. And so here we have a couple encouraging things. One is that young workers are coming back into the trade. Young workers, 19 to 24-year-olds in this chart in particular, we're at a record high for young people in the construction industry. This is also true at the occupational level. So this is at the industry level. So we're talking about you could be in the sales department of the home builder. You could be an office manager. You could be a cost estimator, but you could also be the manual trades as well, right? So you have all of those different types of occupations within the industry. But if we look specifically at the building occupations, the people who actually do the manual labor, we're also seeing good employment rates among young people there too. Now, the differences would be those normal good employment rates in the building trades are happening, by the time you're 22, 23, 24 years old or older. It's not happening at 18, 19, 20 years old. We're still seeing very low employment rates in these trades. That when you first become an adult, we first graduate high school. So I'm not sure exactly how much of that is people are going to college, or they're starting to go to college, or maybe you don't have a job as a teenager, so to figure out how to become, have a full-time job when you're an adult, like that transition from high school to post-high school life can be a challenge. But we do know there's a gap there, and so maybe there's something we could do to line up, going directly from career technical education in high school into an apprenticeship program or into the trades or something like that. Linking those a little bit better would be a place where we could see better outcomes for sure. The other thing here would be we're seeing record number of enrollments in official apprenticeship programs in the state of Oregon, both for construction occupations and installation, maintenance, and repair occupations apprenticeship programs. Now, the median age for an enrollee in an apprenticeship program is 28 years old. So again, that's a long time to go from finishing high school to enrolling in an apprenticeship program. That 10 years is a really long time. So again, better things to do to link up these careers to grow our workforce in construction in particular, because we know we need them, giving all of those federal investments, giving our housing needs, giving all of that. We need even more. We have record enrollments in apprenticeship programs. We need even more than that to fulfill all the needs we have in our society. And so again, we got some good news there, some bad news. We need more of it. And the bad news are those demographics, where those new cohorts coming into the labor force are smaller and smaller because we've had a declining birth rate for 20 years in the state of Oregon. In terms of the big picture risk to the outlook, I think the baseline forecast, the most likely outcome for the U.S. economy and the Oregon economy is the soft landing, where we do go from that really high inflation last summer all the way back, to summer 2022. We do see that come down. We do see the expansion continue. We do see ongoing economic growth at a slower, more sustainable, less inflationary rate. That is the baseline forecast. but that's not the only possibility out there. For the last 2 years at this point, we have been modeling a boom bust scenario where the inflation doesn't quite slow fast enough to target. The Federal Reserve does continue to raise interest rates. Again, I think they're probably done for now. They might have one more rate hike in them, but I don't know if they'll follow through. But they maybe have to raise it even further to head off that inflation. That would probably send us back into a recession because those high interest rates would just choke off so much economic activity. It would drive us into a recession. That's the boom bust scenario. That has been a big fear for the last 2 years since we started to see those inflation numbers in 2022. It was like, oh boy, like these don't historically end well. We don't have a example in our modern history of an inflationary economic boom ending well. By that, I mean not in a recession. And so this boom bust scenario is still possible, is still out there. That risk is still uncomfortably high. It's been encouraging to see what's happened in the last 12 months. But we could still see this play out in a different way moving forward. And then, of course, there is optimism. Like that, everything isn't just pessimistic today. I know it can feel that way, but there is optimistic scenarios out there too, where we do get that better productivity gains. Maybe we get a little bit stronger rebound in migration trends in Oregon, driving our workforce and our economy higher than anticipated. Like there are still good things that are out there, but we tend to focus on the negative for a lot of our social media, political, economic commentary and the like. But again, I think so far things are in a good spot. We'll continue to see how that moves moving forward. But that's kind of the baseline economic discussion. We'll move on to some of the housing stuff. I'm going to first start with fundamentals of the economy, and the first fundamental will be population growth. And this is something that is a tremendously negative conversation I have pretty much everywhere I go, because if you look at the last 80 years of Oregon, certainly since post-World War II, right? So that's not quite 80 years, but almost. Out of those 78 years of data, we have 78 years of data. We have 74 years of positive population growth in the state of Oregon. We have 4 years of negative population growth in Oregon in the last 78 years. 3 of those 4 negatives happened in the 1980s, right? That was when the timber industry restructured. That is when inflation was truly in the double-digit territory. The Fed's fund rate went to 11 or 12%, I believe. The mortgage rates went to 18 or 19% in the early 1980s, right? That meant the housing industry, the wood products industry really collapsed and restructured. Plus, that's when we started to get the British Columbia wood coming into the U.S. market in greater numbers and all that sort of stuff. Like, so it really put Oregon's economy in a tailspin for an extended period of time. And so we saw people pack up and leave the state. So for 3 years in the 1980s, 2 in the early 80s, 1 in the mid 80s, we lost population in the state of Oregon. So that's 3 of the 4 negative population numbers in our modern history. And then the 4th was last year in 2022, right? Census Bureau estimates that Oregon lost population in 2022 for the first time in 40 years and for the 4th time in 80 years. And so our baseline forecast is not for that to be the new normal, not for that to continue. We have a modest, slow rebound in population growth in our forecast. Here you're looking at numbers, they're 10 or 20 or maybe 30,000 numerically. In percentage terms, this is all sub 1%. It goes 0.3%, 0.5%, 0.6% population growth. So these are all sub 1% percentage growth. Like whereas traditionally we've seen 1 or 2% population growth in the state of Oregon. We don't think that's going to come back, both demographically, and there's been some permanent structural changes during the pandemic. But again, working from home, you're better able to live somewhere else and work remotely, especially given our terrible housing affordability is pushing some people away. Like I think there's some reasons to expect population growth to be slower in the years ahead than it has been historically, but we just don't think the new normal is negative. It could be. We have to be open to that possibility that, we're not going to get a rebound in migration. But I think we have 74 out of 78 years of history telling us that this is a place that more people want to live. We still have a lot of job opportunities. We still have scenic beauty. We still have a lot of things that are attractive to people to want to live here. But what happened in 2022? Well, we don't know exactly. Moving is a very personal choice. Some of it's economic, some of it's pandemic, maybe some of it's school related, maybe some of it's political or tax reasons or whatever the case may be. There's a lot of reasons why we would move. We don't have a lot of data to figure out exactly what it was. What we do know is who moved, right? with the latest data that just came out a few weeks ago, we finally were able to look at the characteristics, the socioeconomic characteristics of the people who did move into or out of Oregon. And so what you can see here in the last decade, what changed in 2022? It was not that people stopped moving to Oregon. The blue line, the number of people moving into Oregon, is relatively constant for the last 10 or 15 years, right? Like there's ups and downs. It's maybe down a little bit in 2022, but it's broadly speaking a steady trend of people moving into the state of Oregon. That looks to have continued in 2023. We'll get the official estimates here a couple weeks from Portland State University, and a couple weeks after that from the Census Bureau. We'll get those 2023 population estimates. But if we look at things like surrendered driver's license at Oregon DMVs, like when you move to a new state, you have to give them your old license to get your new license back. Throughout 2023, those continue to be healthy, right? Like, so people are still moving to Oregon. That's encouraging that people haven't like shunned us. What's different is the yellow line. What changed was the yellow line, where the number of people who live in Oregon who packed up and left the state, that increased tremendously in 2022, and that's what drove the overall population losses. So if we look at this, like who was it, right? It was a little bit of everybody. It's kind of like half children and half adults. That speaks to families leaving in greater numbers. It's about half college graduates and half non-college graduates. Given educational attainment trends, like that means it's a little bit disproportionately college graduates who left the state than folks without a college degree. It's about half and half white non-Hispanics and Oregonians of color. Given the makeup of our state, that means it's disproportionately communities of color that were leaving the state relative to the white non-Hispanic population. And then we saw out migration across all major income brackets. Low, middle, and high income households on net left the state of Oregon in 2022, again, for the first time in 40 years. So it's a little harder to gauge exactly what is going on. It's 1 year of data. It's one messed up pandemic year too. Because like thinking about that income, like some people say it's all taxes, right? Especially in the Portland region. That could be part of it for sure. But then that would be maybe the high income households who are able to save a greater amount moving to a different county or a different state or something like that. If it was just housing affordability, which we saw in California last decade, that would be on the low income side of things, right? Like the population loss that our neighbors in California saw was really primarily among young people, old people, and lower income people due to the housing affordability and crisis there. So like maybe that would explain some of that pattern. But the fact that it was across the board, again, could just be one messed up pandemic year. It could speak to broader issues above and beyond things just like taxes and housing affordability. Even if I think the affordability is probably the single biggest component here, there's certainly other things that works. And again, it's a very personal decision on why we choose to do what we do. If there's one silver lining, if there's one positive thing that came out of this 2022 migration data, it's that 18 to 24-year-olds still moved to Oregon in greater numbers than packed up and left the state. This cohort, young adults, has traditionally been Oregon's historical comparative advantage. We have never really been, at least in recent decades, we've never really been a place that attracts a lot of families or people in their mid or late careers. We've been a place that young people have moved to in great numbers. And then they set down their roots. They begin their careers, they buy a house, they get married, they have kids, all that sort of normal stuff you do over your life cycle. We get them here in Oregon when they're young adults, and then that all happens here. And so if this continues, even amongst this sea of bad news, this is a relatively bright spot. That if young adults are still moving here, and then they provide that future labor force growth and that future demand in the economy moving forward, that would be a relatively healthy outcome against this, again, all of these negative trends we're seeing here. So again, that's a 1 year data. We're about to get that 2023 top line numbers, but it's going to be another year before we're able to look at these characteristics of the people who moved in 2023. We're not going to get that data until fall of 2024. So again, it's going to be a while before we know the details. We will get those high level estimates here in the coming weeks. Again, housing fundamentals for Oregon look tremendous right now. That big bulge of millennials, the largest generation alive today, is the economic powerhouse, right? They're in their 30s and increasingly into their 40s, and they're coming up on their home buying years. They're already starting to be first-time home buyers, mid 30s. Here, I got my next chart. Mid 30s in the state of Oregon, even today. 34 and a half, technically, if you do the math on it, 34 and a half is where people hit 50% owner, 50% renter, or right. So like obviously in your 20s, you're primarily renter. As you age in life, you become primarily homeowner. It's 34.5 in Oregon today where you hit 50-50 owner renter. So that big bulge of millennials, the largest cohort in the state, they're in their early 30s and they're going to age through those home buying years in the decade ahead. So there's a lot of demand there. Of course, you're younger in life, you have less income than you will later in life. You have less wealth accumulation, so you're more credit sensitive. So these high interest rates and larger down payments needed for these higher priced homes today impacts millennials to a greater degree than they do for some older populations. Two other quick notes. One is the idea of baby boomer supply coming onto the market as we age, eventually downsize or move into a residential care facility, things like that. That is very much a true demographic trend, and we will see that in the housing market. But given the age structure of society in Oregonians, we very much age in place. We don't really downsize. Some people do, maybe 1 or 2% of people a year downsize, but it's really we age in place. And so that impact of empty nesters moving out of their longtime single family home is much more of a 2030s discussion than it is a 2020s discussion, certainly at a high level, statewide level. Maybe some of our communities are different. I haven't really looked into that yet. But that's something that's coming, not here today, it's coming in the future. The other thing is Gen Z, that generation to the younger than millennials, the kids these days. You'll notice, the thing to notice is they're getting smaller, right? That's that age cohort getting smaller and smaller each and every year. So again, that housing demand, that workforce labor supply in the 2030s and 2040s, if we don't get the migration to come back, is going to be a lot less than it is today because we got a smaller generation coming in the pipeline. They will be the economic power. They will be the driver of the economy in the 2040s and the 2050s. But obviously, there's still elementary school and high school age kids today. That's a ways off for some of them. The demographics, those demographics, that big bulge of millennials has been encouraging, not just in the sense that they are leading the mortgage origination data you see on the chart on the right. Yeah, we've come off the pandemic highs. Everything's kind of negative from the pandemic highs, but who do you see the strongest bubbles in? It's the 30 to 39-year-olds. So that big generation of millennials is driving mortgage demand even in today's down market. And then the chart on the left is like we've seen increased household formation rates within this cohort. We have a lot of people moving into their 20s, 30s, and 40s today. And then within that, they're forming households at an even higher rate today than they have in recent past. We had this long run decline in headship rates, household formation rates in Oregon in recent decades. That reversed significantly, not all the way, but significantly during the pandemic. So again, that's increasing housing demand both for renters and owners. This is Portland data, and I know we're not talking a Portland discussion here. This is just the largest market in the state. I track it every month when the RMLS data comes out. And just the point is that obviously it's a down market. We're in this bad equilibrium where volumes of affordability is terrible, volume of transaction is terrible, and we still have limited inventory. And so it's certainly challenging. These trends are everywhere. Every market I've looked at, I just track the market a little bit closer in Portland, given it's the largest one in the state. But I did update our latest affordability numbers for the October home sales data in a handful of our metro areas around the state. These are the other markets I track. This chart is showing the percentage of local households that could afford to swing the monthly payment necessary to take out a mortgage today, given current interest rates, current home prices, current property taxes, that current homeowners insurance, and that sort of stuff, right? And you can see where we were at the top of the cycle, at the height of the pandemic, the record low interest rates and nearly record high affordability. We had more than 30 up to 40% of households in Medford and Salem markets could afford a payment. That's today down to 25%. So we've priced out 10 to 15% of local households in those markets. And then, of course, we see the worst affordability in Central Oregon and in Bend in particular, where only 1 in 10 households in Deschutes County can afford to buy a home in, this is more the city of Bend data, so it's a little bit of a mismatch between county households and city prices. But again, really bad affordability. The buyer pool is much smaller today, given where prices and interest rates are currently in the market. Now, how do we get out of this? How do we see some improvements in the housing market? This is our big picture affordability tracker, where we're looking at, again, like that monthly cost of taking out a new mortgage. relative to the price of it, relative to interest rates, and relative to income growth in the state of Oregon. This is based as a share of per capita income. That's not the right measure. We want to use like family income, household income, something like that. But this is just spitting right out of our models because we have our income forecast, we have our population forecast, and so I can do a per capita number pretty quickly. But the trends are the same, right? Generally, trends in per capita income match trends in household income. The levels are different. You have higher income at the household level than you do at the person level, but overall they track each other in terms of growth rate. So again, this holds up. You can see where that record worse affordability today. How do we get back down to that long run average you see in our forecast? How does that happen? There's three things that are happening underneath the surface of affordability. Our forecast right now is we get back to that long run average affordability in the first half of 2025. So in the next 18 months, what are we going to see happen that drives that? Now, there's three components. One is a fall in interest rates. Right now, we have mortgage rates of 6% in early 2025. That feels like a big improvement. That's a 1.5 percentage point improvement right now. That feels like a lot, right? So how would we get that? Well, it's like if we get the Federal Reserve to cut two or three times, that's 75 basis points. If we get that gap between 10-year treasuries and 30-year mortgages to shrink just a little bit, that's probably another 0.5 percentage point. So that gets you over 1% right there, reduction in mortgage rates over the next 18 months. It could be more than that. It could be less than that. I'm not married to that view. That is our forecast currently. There's a lot of risk to it. It could happen sooner than anticipated with financial markets, and that the Federal Reserve started cutting rates in the spring or the summer as opposed to next fall. That would speed up this process and things like that. That decline in mortgage rates going from 7.5% to 6% does 50% of this improvement in affordability. Going from the record worst affordability to that long run average, half of that improvement is due to a decline in mortgage rates. So that makes it the biggest, most sensitive component here to pay attention to. The other two components that will improve affordability is ongoing income growth, right? Income's growing 4, 5, 6% a year. And so that means 1 year of income growth is the equivalent from that affordability perspective. 1 year of income growth is the equivalent of a 0.5 percentage point reduction in the mortgage rate, right? Because the mortgage, 1 percentage point change in the mortgage rate changes the affordability calculus by what, 13% or so? So 6%, so roughly 6% income growth to offset 0.5% change in the mortgage rate. So again, income growth will provide 30% of that decline in affordability or improvement in affordability. The other 20% of the improvement will come from slower home price growth. Right now, our home price forecast for the next 18 months is 2.5%. Right? Positive, not negative. I think the risk here, if mortgage rates would have stayed near 8%, since they've come off, it's better. But like if they would have stayed near 8%, I think we could have been in for some further home price reduction. But we have a slight positive increase in our home prices in the near term. Again, there's a lot of variability there. I wouldn't be surprised if they did come in a little negative or a little flat, more flat than that. I would not be surprised. But we do have very, very slow price increases in the forecast. What that means is, well, normally home prices are up 3, 4, 5, 6% a year on average, and we're only talking about 2.5% over an 18-month period. That means we're seeing slow home price appreciation, which also increases affordability as a result as well. So again, most of it, the improvement will come from interest rate reductions. The challenge there is like, even if we get those interest rate reductions, which I think are reasonable in the couple years to come, will we see an explosion of home prices again, right? Will we see an acceleration of home prices that then kind of eat back up and push us back near those terrible affordability numbers? I think that's also a reasonable scenario to think through. But that's not our base case. That's not our baseline outlook, but it's something to keep in mind. Whereas like maybe we get some of these out of these three changes, we'll get some of it, but then maybe it'll offset on the other components. So again, like there's a big risk here, but we need the better affordability to drive better transactions, right? That's fundamental. Otherwise, we'll stay in this bad equilibrium suppressed market where transaction volumes are very low. We could stay there for a while. I think we'll start to see improvements for a couple of reasons. One of them has to do with Better inventory numbers are going to come from people just having to move. Some of us are going to have to move because of jobs. Some of us are going to have to move because we get married or we get divorced or we have a kid and we need an extra bedroom or we want to be in a different school district or maybe our parents get sick and we got to go take care of them. Like we're going to move, right? This lock-in effect of having a sub 3 or sub 4% mortgage rate is real. It is out there. I refinanced at the bottom of the cycle. So like, I don't want to give up my sub 3% mortgage rate. I hopefully will never have to, but at some point I might have to because life events happen. And so that means this impact of the lock-in effect is fading every day. It's fading a little bit more. And so we just got some Q2 numbers from the FHFA, and we've seen in the last 4 quarters, we've seen 28,000 Oregon households give up a really low mortgage rate. And we've seen 20,000 more new households take on a new high price mortgage at today's interest rates, right? So like we've seen these shifts happen, like, even if we don't want to personally, in some cases, it just is going to happen. And so this lock-in effect is fading every single day. It's fading and getting smaller and smaller, even if it's still sizable, because we have 2/3 of Oregon households today with an outstanding mortgage have a rate below 4%. So again, going from, if we get back down to 6% mortgage rates in 2025, if you have a 3 or 4% today, it's like, oh, I could do that. I can make that math work, especially if I'm trading up. I have more income. I need the extra bedroom for the kid or whatever. Like you can make that trade up, but going from 3% to 8%, like that's a lot harder of a sell. And so as these normalize, we'll start to see better inventory, better transaction numbers here for sure. The other one would be housing production, increase in new housing supply. This is single family housing starts in the state of Oregon. I said better production, better increases. It's not really, it's kind of flatlined, right? This is what we've done for the last decade, is build about 10,000 single family housing starts a year and roughly 10,000 multifamily housing starts a year. And you can see we saw a big surge in single family homes during the pandemic. That came off as those mortgage rates eroded affordability. Builders kind of delayed some stuff because like the market just went haywire. But that started to revive again in recent months, and we're kind of back to that number. The last thing I'd note is we need even more than that. We've underbuilt housing in Oregon. Our affordability is terrible. This is our housing fundamentals from a household formation viewpoint, plus our housing starts forecast in yellow. We do have a 10% decline in housing starts in our forecast. That's almost entirely on the multifamily side. It's really hard to get projects to pencil out today, given high interest rates and where rents are. Builders, developers just can't get apartments to pencil out today very easily. So we think there's a decline there. It's already started. It's going to go for at least the next few quarters, and then we'll see how that plays out. I think the demand, the production on the single family side is a little bit better. But you'll see here again about 20,000 housing starts in the state of Oregon, relatively stable, giving underlying population and demographic forecast. We need to build even more than that. So lastly, one quick thing to note, some of you are probably very aware of this, maybe intimately familiar with being involved in some of the policy groups about it. Oregon has in recent years passed the Oregon Housing Needs Analysis. What it does effectively is it's trying to estimate all of these components to figure out how many housing units do we think we actually need to build. We're building 20,000 units a year. That's not enough. We need more than that. So how many do we actually think we need to build? Once we come up with some estimates about how many we need to build, then how do we get cities and counties to, and how do we get private builders and affordable builders and cities and counties to actually provide as much housing as we actually need in the state of Oregon to improve affordability and improve our economy and all that sort of stuff. In the most recent legislative session, our office was written into this. We knew it was coming, like we've talked about it, but we have officially been written into this to do that initial analysis, to estimate housing demand and need by city, by region, by bucket of income group, whether you're low, middle, or high income, for existing supply, for projected need, for taking into account vacation homes and second homes, especially on the coast and in Central Oregon, and then of course housing for our unhoused neighbors. And so like this stuff is coming in the pipeline next year. Our office, I will be working on this quite a bit to work on it. So again, we'll have some of these estimates, and then the hard part will be making sure we have public policies in place to incentivize and encourage building how much housing we actually need, so we don't just stay at that 10,000 unit a year trend, which is underbuilding relative to fundamental demand to live in the state of Oregon. So that's everything I had prepared for today. Here's my contact information. I'm always happy to chat. Give me a call, send me a text, give me an email. If you're interested in anything you just saw, you can follow along on our website, OregonEconomicAnalysis.com. Post about one little tidbit of research, a research piece a week. You can sign up for email alerts on the right-hand side of that when you're on that website. And if you're brave enough, you can follow me on social media, most social media accounts. A lot of economic stuff, but then you have to put up with football and beer as well. So that'd be on you, but you're welcome to if you're interested. So thanks for your time this morning.
Any dogs on your Instagram?
No dogs, no pets in our, well, we catch critters in the summertime, but no real pets.
Okay. Well, if we can, let's go ahead and answer some Q&A. So regarding the people who are leaving the area, so half children, half adults, half college grads, half non-college grads. Does that mean college grad parents with children left Oregon, or is the college grad criteria only used for adults?
Yeah, I think that would be the normal implication. So the way the data comes is in September, the census releases what are called published tables, where you just get like one slice of the data. So you can look at by age, you can look by educational attainment, which is only for those 25 years and older. It sounds like the person knew that. And then you can look by race and ethnicity or whatever. Like you get one slice of the data. Then you get what's called the micro data, the underlying data, the actual responses. And then you can do the crosstabs of figuring that out. And that only came out a couple of weeks ago. I have not been able to fully get that nailed down, but it does look, to me, it does look like that would be the case. College educated parents with young kids would be a large component of the outmigration.
And is that something available on the website then, that new information?
You can download it from Census. It's gigabytes of data and you have to crunch it all yourself. It's coded like survey. It's the mess, but like we'll get there. I'll work on it, but like it takes a while.
Also regarding who left Oregon, is there data of which counties people resided before leaving Oregon? And if so, which counties saw the largest decrease in population?
Yes, there is. And in that new data that just came out a couple of weeks ago, we can get down to very detailed levels of where they lived and where they moved to. And that, again, I don't have all those details. At a broad speaking, I would say two things. Obviously, Portland has been the epicenter of the population losses in the state of Oregon, but it's not just the Portland region, not just Multnomah County. It's not just the Portland region. It's pretty broad based. And the Census Bureau, if you go from 2021 to 2022 data at the Census Bureau level, the county data nationwide, they have a very pessimistic view, a very large shift to the negative outflows up and down the entire West Coast, right? You know, it's in Western Washington, it's in certainly Western Oregon, it's certainly up and down California's like entire state. So like it's a broad regional shift out of the West Coast and into the Intermountain West for sure.
So with that said, are there states with similar demographics that we should look to for trends?
The challenge is we're pretty unique in terms of we have an extra large baby boomer cohort, we have an extra large millennial cohort, and then we have a bottom 5 birth rate on top of it. So like that nature of it is fairly unique. But we do look regionally, right? And so like the Western United States used to be growing quite quickly, right? And during the pandemic, that shifted. The West Coast is not growing quickly. We're losing population. The Intermountain West is maintaining their growth. And then we saw a big acceleration in the South. So like some of that's still certainly true. So we do stack up, but we're kind of different. So I don't have a great answer off the top of my head, but like we're kind of unique in that, again, the baby boomers, millennials, and then no kids. Like that's a little different.
Can we rely on continued income growth? It seems as the pressure on the job market becoming more employer friendly could limit income growth, coupled with inflation being a little more elevated over historic values. Could these influences alter affordability even more in any real sense?
Yes, and so the challenge here is the challenge is like macroeconomically at the top line economic level, we need slower income growth, right? Like because that will slow the inflation. And so then it's like the Federal Reserve has a 2% target, and come hell or high water, they're going to hit their 2% target or at least come really close. And so we need slower growth, slower income growth, slower consumer spending growth to then help ease the inflation to get back down so we don't have to have a recession, right? Like that's the outcome we're looking for. Of course, at the individual, I don't want my income to slow down. I don't want to stop spending, but like the individual versus the macro stuff for sure is an issue. But we're still seeing our wage growth is faster than the U.S. right now. If we look in recent months and recent quarters, and so we're seeing better income growth continue here, which again is good for us. But yeah, so I'm not sure. Does that help? That will help with affordability. Better income growth helps with affordability too, as long as the prices aren't increasing at a faster rate than your income.
Well, and speaking of affordability, we have another question. What is the criteria that you use to define housing affordability?
I look at that monthly housing cost as a share of income, right? And you can do it across the income spectrum. Most of my stuff that's either at the median, like the median household income, or in that case, the per capita is kind of the average income level. But that's what I focus on, is the monthly housing cost. And then again, relative to income, it's like, yeah, a new mortgage is $4,000 a month these days. But like, if you have a $150,000 income, like you're fine. So if you had $70,000 income, like you can't really make that work. So like you have to account for the income growth too, not just that housing cost. So it's really that ratio.
So you spoke to the amount of new construction, how steady it's been here in Central Oregon. We've certainly seen that being a very prevalent piece of our real estate market. So we have a question regarding what type of public policies would encourage more housing construction.
Yeah, that's great. So what have we done so far? What is I work for the state, but obviously I don't pass any laws or do any of these policies. There's been some changes on sort of small scale incentives. And by that, I mean, things like with the House Bill 2001, the duplex legalization. So we can now build duplexes and triplexes on most lots in the state, as opposed to being exclusionary single family only zoning, right? So that will boost supply. Like that's a boost to housing supply and boost to buildable lands and that sort of stuff. It takes time. Like redeveloping a lot takes time. When you get a house that's 80 years old and is falling down, you have to demolish it and replace it. And if you replace it with townhomes, like that is a boost to housing supply, but that's small scale and will accumulate slowly over time. It's not a magic bullet. The issue that we talk about a lot around land supply in Oregon is in some ways in my view, can be a little bit misplaced. One is the urban growth boundary discussion. In theory, and hopefully in practice, it's supposed to have 20-year land supply, right? So if it's reasonably close to actually having a 20-year land supply within the UGB, that's not the major issue. What's the major issue is the effective land supply within the UGBs, where we have like, yeah, there's land out there, but it needs to be entitled, needs to have the infrastructure. We've got to get the building, turn it into a buildable lot in a timely, reasonable manner. Yes, need to have that 20-year land supply. Absolutely. If it's not a 20-year land supply, that's what the state law is. We need to make sure it is. But that's the discussion we always have. But it's like, well, we need to make sure the land that's already within the UGBs in our state actually buildable. And so that's where it comes into public infrastructure and the processing and the permitting and the inspection of projects and the timeliness of the construction industry, like the making sure that all of our rules and regulations, which have a lot of benefits in terms of health and safety and the planning and all that sort of stuff, like we make sure that's not a hindrance. And so like that is really the goal and the issue. And so, yeah, so when we talk about we need more construction workers to build more housing, we also need more city and county workers to, again, approve plans, inspect projects, build infrastructure as well. And I've chatted with the counties and the cities about that and the legislature about that as well. So again, I think we know what needs to be done. We just kind of need to follow through with it.
That's always a conversation here as well, the permitting backlog and just the employees and be able to process them. In your opinion, what is the reason for the relatively large spread between the 10-year treasury yield and the 30-year fixed rate mortgage?
So I am not a financial market expert. It's hard to know. I think part of it has to do with the Federal Reserve, right? They were buying mortgage-backed securities for much of the last 15 years. They stopped that, right? In the last 2 years, they stopped that. And so you took one large buyer out of the market, and then they're not exactly actively selling them into the market, but they're letting them mature and roll off their balance sheet. And so that is one dynamic. That's probably the biggest dynamic. The other thing is just fear, just scared and fear. And then the other thing is refinance risk, right? Is if you take out a mortgage today at 7.5% roughly, right? Probably. But if those mortgage rate forecasts are reasonably right and they're 6% in 2025 or lower, who knows, right? Like in a few years, you will be able to refinance, right? Even in a recession, you'll be able to refinance as long as you have the financing. But like the rates will come down eventually. So that 7.5% mortgage rate today is really only a temporary thing. So if you're an investor and you're buying mortgage-backed securities and you're like, oh, that's a good rate today, but if they're all going to refinance in 2 or 3 or 4 years, then your investment's only good for 2 or 3 or 4 years until that buying pool, the loans that are actually in your security are then gone. And so they're demanding an extra premium on top of that because they know it's not really a 30-year investment. It's a 2 or 3 or 4 or 5 year investment. And so again, like those factors I think are the big ones. But we'll see. Financial markets are also, they can do their own thing at times.
And regarding interest rates, we have another question regarding the Fed needing to borrow at some point. How does this filter into interest rates as they do not want to borrow high?
I guess I didn't follow that. Sorry.
The question was the Fed will need to borrow at some point. How does this filter into interest rates as the Fed does not want to borrow high?
Oh, the federal government. Yes. Yeah. So real quick, if we think about what are the high interest rates today doing, obviously they're impacting housing and construction more broadly, but they're not really impacting households that much. A lot of our debt is fixed. A lot of us have 30-year mortgages, you know, and so like that debt is fixed. Our credit card balances were good. They're starting to deteriorate. We don't have a lot of revolving loans as a share of our household budgets that the high interest rates are really killing us. So households are relatively muted impact so far from higher interest rates. Corporates, at least large businesses, are relatively muted too. I think, you know, if you look at the S&P 500, so the biggest companies, more than half of their corporate debt matures in the 2030s. They refinance during the cycle too, and they put their corporate debt out a decade. So like they're not really impacted so much by the high rates. That leaves the government. The federal government has 60, 70% of its outstanding debt, federal debt, matures in the next 5 years. And so the federal government is going to be rolling over a tremendous amount of debt at these higher interest rates in the near term. So that is where the genesis of the question is coming from. And it's a very important point. So how do you balance that? I think it's an impact on the federal budget. Are they going to raise revenues? I don't see a lot of people running for Congress or president talking about raising taxes. And we're not really going to slow down spending, given entitlements and given the upcoming infrastructure investment and stuff like that. So it's going to put a different dynamic on the market for sure. We're not going to spiral. We're not going to have hyperinflation. We're not going to do any of those sort of crazy things. When you have the global safe haven currency, you have independent monetary policy in the Federal Reserve, sets your own interest rates and that sort of stuff. Like we're gonna have to work through it. It's a challenge, but it's not like some sort of like crazy scenario. But it will crimp the federal budget, just given higher interest rate costs. So yeah, is it going to really tank the financial markets? I don't see that happening, but you never know.
Okay, looks like we have one more. Developers need projects to pencil. Do you know if the state provides low interest loans or grants or will in the future to help projects be financially viable?
That's right. There are various programs that are available. The funding streams, of course, are myriad to say the least. I am not well versed in that, but I do think whether it's underwriting some loans or backstopping some loans or something like that, for the public sector to take on some shared risk, future risk to provide for the public good is a natural role for the public sector. But whether we're doing enough or need to tweak those projects or not, programs, I can't answer at this time.
Well, I think that wraps up the questions, Josh, thank you so much for your time. We really appreciate your expertise, and this was an excellent presentation. For our realtor partners that are here for CE credit, please look for your certificates by the middle of next week. As Hannah mentioned, we have nearly 500 people on this call, so it will take us a little bit longer than normal to process all of your certificates. We'll be sending out the recording next week as well as Josh's information. If you have any further questions for him, please feel free to harass him on his email or his phone. And then reach out to Hannah, Amy Corey in the Valley, or Amy Delamarter, or myself, here in Central Oregon with any questions or needs. So have an incredible week, and thank you very much for your attendance. Thanks again, Josh.
Thank you, Josh.